So if we break it again, that's where the long end of U.S. Treasuries risk, a larger move, in my opinion, to the upside, and that would be, in my framework, a capitulation by the long end of the bond market, um, conceding on this entire kind of framework, this setup that we discussed, where okay, Scott Bessent, we agree, you're going to get it. You're going to run nominal GDP high, and there's nothing we can do about it. So, we need higher rates. So that's what we're watching for. That's where I would draw the key levels right now, as a trader or fixed income allocator for the long end of the yield curve. Now, any questions there?
I would say so. Something that's interesting to me is that you still have Trump pressuring Powell to cut rates, right? And so that seems almost antithetical to kind of what you're seeing in the market itself. So maybe can you explain the why is there pressure from the Trump administration to push Powell to actually cut rates when when Bessent has already said we're kind of giving up in terms of trying to roll the debt over. We're going to just say, look, we're not hot. Why still
Yep.
pressure Powell to do that?
Yeah. So what we're talking about here, this chart is the long end, right? So it's the right side of your treasury yield curve. It's also the least by far amount of capital out there, right? So it tells you what the treasury would have to pay to a kind of a free and open market on the long end, right? They're still doing a lot of financing there with the SOMA account. So it's not entirely true, but this is what insurance companies, pensions, et cetera, would charge on the long end. The front end is what Donald Trump is pressuring Jerome Powell in on the questions, on a day-to-day basis, where we see all the headlines, like every article, whatever happened in the markets today. Yahoo Finance is going to say this was because of what investors think the Fed's going to do next. It's like that's not actually
The
uh,
soundbite just trying to get
how
you
this
to,
works, but
yeah.
it's a very easy and like non-refutable, core position or thesis. But what Trump is pushing for on the front end would be like Fed funds or overnight rates for the most, liquid and marginal source of dollar capital into the overall financial system, which is also anchored to where more and more of the maturity of the debt is, as we get more and more front loaded, right? So that it's also it's actually not the highest cost of debt anymore. Like
I think like the 2 to 3 or something
Fed
is
funds at 4 to 4.25. No, 2 to 3 is the lowest.
lowest. Sorry, yeah.
Which just broke above 4% today on the NFP print. So that square root sign or the check mark sign on the curve, like the low point of the curve is like that 2 to 3 year. Um, but what Donald Trump is pressuring for is the front end cuts, which would really hit money markets, SOFR, et cetera.
And those are in the 4% range
Would
right now.
everything variable rate, tied to SOFR or that financing would get cheaper, right? So real estate loans, a lot of mid-market credit, like anybody who can't do fixed rate borrowing, right? So those lower rates will make it easier in the U.S. economy for like the riskiest sectors to finance themselves, roll over old debt, um, without belt tightening on some real estate projects, let's say, that took out financing in 2020, 2021, et cetera. Or it just could be, yeah, the new small business, middle market business, those size, or that kind of component of the U.S. economy, getting capital financing. Like it makes project financing, employment growth, all of that easier for the riskiest borrowers in the economy, which is like, if you're the president, you're like, well, I want to see more jobs growth. I want to
Say
see
to tie it back to the very
nominal
beginning.
GDP
Yeah.
up, cut, and also it helps the treasury, right? All of the financing and bills, and the front end, a cut of 100 bips might lower your interest expense by 20%. So you're in line to try to pressure the Fed. Now, if you're the Fed and you do that, what you're effectively doing is you're putting more pressure on the net interest margin of banks, right? Because most of them would be dependent on that interest income coming from where the money market rates are, anchoring to. And it actually makes things harder for your banking system, the US commercial banking system, which is who the Fed represents, right? It is their business franchise. So you've got this juxtaposition. Someone's going to have to um, budge here. Ultimately, the Fed does show in their economic projections they do see cuts, but right now, if you cut, certain things happen, which, like last September when they finally started cutting, what happened? They lost the long end. So you're at a point where you're between the rock and the hard place if you're the Fed. And ultimately, like the how the economy progresses is going to, inform them what they need to do. I would still bias, like market still shows 2 year is below the front end, so there's still cuts on the horizon on the short term. It's just a matter of when they can actually be implemented.